Hi, everyone, and welcome to our bi-weekly conversation with Bernhard Rannegger about all matters insurance, decision-making, risk management. How are you? What's been happening? Anything exciting in the
I'm doing
last 2
great.
weeks?
No, I'm doing great. Hope you do too, Alex. Yeah, I know that the exciting things. I think like a lot of interesting conversations we definitely have. Um, I think like we also discussed before about it, right? Like a little bit like the messaging people get like finally now more and more like the importance of quantifying the risk, ensuring like that the coverage fits, right? And also we find better and better words to communicate that into the market and people getting it. And I think it's just like it's fun right now building at that intersection and just like making things work, right? And seeing the eyes of people, seeing ScyAI work, seeing yeah, just like getting like better outcomes and stuff like that. And I think that's just like fun to work on. I don't know.
Yeah,
How about
easy.
yourself?
I mean, besides traveling a lot, way too much, and finally happy to be at home. Um, it's fascinating because I think what started as a very much a hypothesis about 5 years ago is is more and more, I think, proven through various conversations and different companies. It started as a hypothesis that insurance or certain types of insurances, and we spend most of the time talking about PDBI. So whenever we say insurance, for the sake of this conversation, let's just keep in mind that it's probably
Exactly.
PDBI that we're talking about. um, Starting with the hypothesis that insurance was mispriced, and then going to the market and kind of testing that hypothesis and proving that hypothesis, but discovering the next hypothesis along the way, because the next one was a bit of a surprise to me. I thought surely companies are buying the right insurance. Surely, they've been doing this for so long, and they've got brokers that support them and help them place the risk. So surely they may be overpaying, but at least they're buying the right amount of risk cover. The limits are sufficient, and the terms and conditions, the clauses that they insure, surely that matches the underlying risk, and it doesn't necessarily excludes things that shouldn't be excluded. And imagine my surprise when none of these three hypotheses kind of held. um, not only the companies are overpaying, but they're not even buying enough. So they're trying to save money by buying less, if that makes sense. I mean, that kind of goes against the whole concept of insurance and insuring your tail. Buying less tail protection seems to be the strange way to go about things. Rather than increasing your retention if you wanted to buy less coverage. um, but uh, but buying less insurance was most of the time without even knowing it. Quite a few conversations we had, people were convinced that they were fully covered for the actual risks, only to discover they needed to like double, triple, quadruple the limits to actually cover the loss scenarios. And then on top of that, overpaying for underinsurance that they have. And then on top of that, the way the policy wordings are structured is they think that if a claim happens, they will kind of get the money back, and that never happens, or almost never happens. So it's like surprise on top of a surprise on top of a surprise. I think it's a fun world to live in, because by solving any of these challenges, you can kind of get value from the process. Yesterday the process looked like this and it costed this much. Today it could look different and cost less, and the improvement is tangible and kind of and significant. So that, I think that's a fascinating discovery.
100%. And also like just like listening to you talk, like this one piece where you mentioned now, yeah, okay, there is like this possibility for reducing the price or getting a fairer price, right? But then like kind of the learning that if people do that, like they literally play zero-sum games where they just like focus on, yeah, okay, but I'm gonna have like a leak of coverage on the tail risk or whatsoever. So I'm just like, they see it more as like a trade. Okay, I'm gonna, to reduce the price, I have to actually get less coverage or less adequate coverage, right? What we did now, I think that was a very interesting learning that we had was, hey, it's kind of like these three levels or three levers, right? The first piece, hey, we want to understand before you talk anything price or whatsoever, understand your risk quality, right? Understand like what are you actually insuring, right? And C, is your current coverage actually adequate, right? So kind of like these two things. First of all, you want to create like your digital risk twin of what you actually are exposed to. And then the other piece, you want to understand like your insurance, which is a little bit similar to, again, like I would say like not a endurance twin, but it helps a little bit with the understanding, right? Like where you have, hey, this is like your risk quality, which is a digital risk twin of what you have there right now. Then we bring in like the overall insurance coverage and see if it actually matches. And only then at some point, right, you can discuss like further pricing and stuff like that. And for me, even I have to acknowledge like I got that wrong. I always like directly went like to the price, right? Hey, I want like for the right coverage, the right price and stuff like that. But it's way worse than that, the situation in the market. We actually have to ask first, hey, is the coverage adequate? And then we can figure out the rest.
Yeah, but I mean, this is a big point, because whenever I mention to somebody that we are saving money on insurance, people have this preconceived notion that saving on insurance is easy. You just increase the deductibles or reduce the limit. And I'm saying, no, it's neither of these. Well, first of all, you have to be insane to reduce the limit, unless your actual engineering risk scenarios tell you to, which, by the way, never happens. I mean, I have never seen that happen. We had to quadruple the limit once, 4 times, 400%. That's a lot of extra capacity, and it was, I mean, like it was full on, because we used to insure with one company and we were kind of on top of their maximum capacity that they could allocate to our risk, and then suddenly we have to like either co-insure or find a lot of reinsurance capacity. That changes the whole placement strategy significantly. So increasing capacity is not easy. But what we're talking about has nothing to do with undercutting your limits. I mean, that is crazy. Like that's just bad risk management, because your whole purpose of insurance is to protect the tail.
Exactly. That's what everybody directly understands, right? And I think it's such an important point that you make. Like when you talk or when I talk about, hey, we want to actually like get a fair price or reduce costs, right? We are not talking about changing the limits, etc., and then just like praying, right? Like it's really, hey, no, the coverage has to be adequate and you get a better price. It's win-win for you.
And be fairly priced. Yeah, no, exactly.
Exactly.
And it's the same with deductible. I remember it every single conference. I go like, oh yeah, we saved this much money on premiums this year, and they go like, oh, what did you do? Like double your deductibles? I'm going like, no. But by the way, last year we actually reduced our deductibles 15 times. So we went from like a very, very high, like multi-million-dollar deductible to like $500,000. So it's not about that at all. Like, you wouldn't need to be good at risk management if your best practice is to cut the limit or increase the deductibles. That's not good risk management. That's bad risk management. Good risk management is about something else, and I think we'll every 2 weeks, Bernhard and I kind of go live and we slowly unpack that message. All of our previous sessions, and I think this is number 4. All of them are available on the Risk Academy YouTube channel and on the LinkedIn channel that you're watching this now. So you can kind of go back and replay, and we're slowly unpacking it. And last time we talked about kind of experimenting and trying to understand how is insurance priced and how to approach the market. And I think today we're going to get to like my favorite, most controversial part of the placement, where the broker comes into the picture. And I may have mentioned some of this in the past, but forgive me, our regular viewers, if that's one downside of every 2 weeks instead of like every week. I kind of forget some of the things that we've discussed, but it's it's all fun.
It is what it is. It's fine.
Yeah, but so today I wanted to unpack the next big difference, and I do remember that I started talking about this, and we've discussed it a bit with the brokers. When I first inherited insurance management at it's a very large chemical fertilizer company, the traditional approach was to sometimes run a tender, sometimes just kind of send requests for not even for quotations, but requests for proposals to different brokers, meet with different brokers, and then each of the brokers would send you a PowerPoint presentation with their capability, CVs of key people, the systems that they use for claims management. Sometimes they kind of preferred wording or recommended wording, but they would basically send you this marketing brochure that promises that they are very good. And the challenge I had when I started reading these brochures is that they all look the same. When you take like top 3, top 4, they all have capable teams, or at least one team is not distinctly, obviously more capable than the other. They all have the same, similar claims management software. They all have global networks. They all have access to, that they argue, same claims data and statistics and analytics. They all have connection to the same, reinsurance climate quantification engines, and it was impossible to distinguish between the brokers. They all kind of promised a big promise, and I did fall in for that promise for the first time when we did a D&O, and I immediately regretted it. Like we went through the process, they've placed our risk. I hated every single step of the way. I mean, the amount of anger and negative emotions I've experienced during that placement was unbelievable. And the reason for that was that when you select a single broker and that broker brings you something, there's no optionality. Like you can argue and tell them to go back and try better, but there's only them. Like there's only that much you can push, because it's whatever they bring. This is it. That's the final thing. You don't have time to start fresh and kind of go to the same markets. They've contaminated all the markets already anyway, and as you kind of start to discover the methodologies and the logic and the arguments that they use in the market, and you don't like these arguments, you disagree with the approach, it's already too late, because they've contaminated everybody, and because they've spoken to everybody, and B is there's nothing to compare. It's like you have you in one lane and one lane on. You have to accept your fate, and that was such an uncomfortable position that I immediately went, this is not right. We should not continue down that path, even though everybody does that. We should just see if there is a better way.
Mm.
And it was interesting because one of my insurance managers, the head of insurance that was in my team, he came from one of the brokerage firms, and he was like convinced that that's the way everybody does it. Like that's the way to go. He used the same arguments that I've heard dozens of times since, that if you use multiple brokers, you will ruin the markets and the underwriters will not like it, and it will only bring pain and suffering and no good will come out of it. And they used all sorts of other fascinating excuses. So obviously, me being me, I didn't listen to any of them, and I decided to experiment in the market. And so the next placements we've done by shortlisting 2, 3, sometimes 4 brokers based on their brochures. And for me, the kind of the easy selection criteria for shortlisting a broker would be asking them for claims statistics relevant to our industry and our geography, and whoever couldn't provide it, they wouldn't get shortlisted.
Mm.
It's a fascinating thing because, well, again, to my surprise, remember this was many years ago. I was still discovering, how this whole relationship and the broker competency works. The one thing I was surprised by, for example, is that the brokers, the placement brokers, or at least, well, first I was surprised by the fact that brokers have the salespeople and the actual placement people, and it turns out everybody I was talking to originally were the salespeople. So that stopped pretty soon. Like that stopped immediately. Never since I talked to a sales person for longer than 15 seconds, because they didn't really help much. I needed the contact with the person who's actually speaking with the underwriter, or even better, speak to the underwriter myself to get the message across. But that will come later. So that was an interesting surprise. There's a lot of salespeople. I don't know, probably maybe more salespeople than actual people that do the placement work. And then the second discovery is that both the salespeople and this is like really scary, both the salespeople and the placement brokers don't understand risk math. Like they have no
Exactly.
grasp of loss exceedance curves, expected losses, unexpected losses, like tail scenarios. It is very, I mean, obviously there are exceptions, and I've met some really good exceptions, but they are very rare. So that was like, now that was actually scary, because I thought I would come to an equal and talk the language of risk, and that person would understand me. But as it turns out, most people had no idea what I was talking about when I was trying to kind of estimate what is the fair price of a policy.
And I think, let me chip in there. Like, I think what's super important to highlight there, like, it's kind of these 2 points. Like, a lot of the stuff is just window dressing, and you want to cut that piece out. That's what I'm hearing from you, because a lot of the sales pieces and stuff like that, they're not really you're not talking substance. Then there's these other things. Yeah, we have all of these great analytics and stuff like that, this tooling that you get, etc. Again, window dressing that they provide. And then what I liked, what you just like shared, is you would ask them, yeah, share with me relevant like benchmarking, claims data, etc. into the market. And for me, this sounds super smart, because you directly get them to talk to the person that can talk about this data, and you directly have like this kind of filter out. So talk to me little bit more about that, because I think that's super interesting. Directly where you cut through the window dressing, right? That just like makes like the world turn around for them, right? But not for us.
Yeah. So yeah, once I kind of got over the surprise that the people that I was talking to didn't understand math, um, then there was kind of, there was this fork in the road. Either they were smart enough to realize that there is somebody within their global firm that does understand math, and they would connect me to their analytics
Mm,
department, or they would be arrogant enough, and that's a whole separate story. The arrogance of salespeople at the brokerage is just unheard of. It's insane. Like I'm guessing the business model is built on so much macho bullshit, dinners and road shows and travel, whatever they're doing, none of that made any sense to me. Like, for example, the people, I remember people going like, oh yeah, we go to London to do a road show for for a week and spend, like it's a great holiday paid by, our companies. I've always done like road shows via, virtual, and I couldn't grasp like why would you expense all of this nonsense and the conversations, and why would you have a dinner with or like a lunch with your broker anyway? Like they just made no sense. By the way, I had a rule. No one from my team was allowed to meet a broker or an underwriter face to face or like one to one. It always had to be two from our team present, because I was genuinely worried about all of the corruption in the industry. And
mm,
I did have someone offer me money, like a 10% back on whatever we paid them. And obviously I refused. Like that's completely unacceptable. But this whole environment is weird. So anyway, going back to my story, um, the fork in the road, somebody who can find a person who understands analytics, and somebody who is arrogant, and they would get blacklisted immediately. I mean, I remember we blacklisted one of the French brokers. It was so funny. The guy was like adamant. He's like, no, this is like our super private information. It's our competitive advantage. I'm going like, no, it isn't. Like everyone is giving us their statistics. And then because they don't understand math, because they don't understand how distributions work, they're like, oh, it's sensitive client data. I'm going like, yeah, use the metalog. You just generalize the mathematical relate. Like, give me a formula. I don't care about individual claim. Not like there's like a million way to mathematically share relevant information without exposing anybody and protecting all the sensitive data. And if they don't get it, they don't get it. So they get blacklisted. But then I would get contact with the data analytics team from that brokerage, and then there's a second fork in the road. One is they understand that having data is inherent in the broker-client relationship, and they would share the data when we ask for the data. And then the second option is they would try to sell it to us as if this is like an advanced package, extra service. And I'm going like, this is not extra service. Like, this is literally the only value that you bring to the table. And if you think that we're going to pay extra for the basic value that you should be bringing by default, you're very much mistaken. So that fork in the road we had to cross multiple times as well. And that was interesting, because to this day, major brokers think that selling data analytics is like an extra service, not a fundamental component of the broker conversation and part of the inherent value that they should be giving, but like as a separate paid service. I mean, the guys are clueless. Like, they have really no idea how placement should work and what clients actually need. Because just imagine, poor insurance manager sitting there and going like, oh, I need to go back to the CFO, ask for like another 50 grand, or whatever the cost is, or 20 grand, to justify just getting the loss exceedance curve. Which, by the way, which is another interesting thing, when we did get these exceedance curves, most of them were incorrect anyway. So like the quality of data analytics, it wasn't that amazing to justify paying anything for that. So like that, it's a weird world, but we use that to shortlist some of the brokers that we can at least find common ground. And I think that's the key takeaway that I'm trying to share is I needed a way to find common ground with the broker, and sharing and access and transparency around claims data proven to me one such example, because other promises of the competency and the fact that they're working with clients similar to us, all of that didn't really kind of show enough empirical evidence to prove that they would actually be a good fit. So and as time goes by, we did have best relationships with the brokers that were forthcoming with the data when we asked them, didn't like make a big deal out of it, didn't cry me a river about client confidentiality, because they found a way how to preserve it, because it's not that complicated. So shortlisting 3 or 4 good brokers in each line, that was important. By the way, another huge surprise for me as we were kind of going through that journey was that in the past, and to this day, I know like certain countries where this is common practice, you would get like a single broker, and then that single broker company would get you all different policies: marine cargo, PDBI, liabilities, D&O, cyber, whatever you need, they have it. And that was super weird, because what I kept discovering is that some brokers are better at some lines and some brokers are better at different lines. There is not a single company on the planet that is equally capable of placing even the biggest ones. And we've tried all of them in different countries, in Latin America, in North America, in Europe, in Africa. It's just like there's no way a single company can service different insurances, different needs. So that means we started having a short list of like preferred options for different lines. There's a separate short list for cargo. There's a separate short list for PDBI. There's a separate short list for constructional risk. There's a separate short list for liabilities and so on. Yes, yeah, they overlap sometimes, but it's definitely not a matter of getting one best broker based on their marketing brochure and then kind of placing all of your eggs into this one basket. That is literally like the worst risk management I can think of just giving everything to a single company.
Yeah, you would think this is the default, right? Like that you kind of like what you say, like these are specialists actually like in this specific mining vertical. And then, but actually for me, like to then transport certain elements that are extracted from the earth, right, for logistics and stuff like that, I will use somebody else, right? Because they have like, again, like the right underwriters in mind, the right like analytics, the right data on that stuff and so on. Like you would assume that this is like just like the default that things work, but it's just like it's not, because like the cake is also big, right? People like want to do like all kind of lines, over promise as well. I think like the over promising is also a big problem. But then just like listening to you, Alex, right now on that front, right? How have you experienced this then with your peers or CFOs as well, that you actually want to split this up and have multi-broker engagements and stuff like that? Did you ever have like actually pushback then from your CFO, etc., and how did you handle that? Or were they just like, hey, Alex, you go ahead?
So I mean, that's actually an interesting question, because I never thought about that, because I've never experienced it. I mean, maybe I was unlucky, but I'm yet to meet a CFO who would care enough about insurance to have like a strong position saying like, no, we should do this. We were always kind of left to experiment, and then as long as we proven that the experiments worked and we were able to show, we've tried 2 options and out of, or 3 options, and out of 3 options, this one gives us better coverage, better limits, better deductibles, and a better price at the same time, and better wording, then this is good enough. I don't think I've ever had any pushback from the business. You only get pushback, ironically, from like different brokers and your current underwriter. They all come back with the scary stories, or like, it's never going to work, and don't do it. It will make things worse. By the way, not once this was proven true. Like, not once. I think no. So actually, let me take that back for a second. I did have 2 like funny stories. I mentioned one of them last time. Once procurement thought that buying insurance is just like buying a piece of equipment, and they can negotiate risk coverage from inside procurement team. And that was a joke. I think we outperformed them by like 40% or something. I can't remember the exact number, but it was fun. We've experimented. We've given them something to try with the current underwriters, and then we went to the market and kind of did our thing. And I mean, they were left in the dust. So that, I think, is a big mistake when insurance is not procured like a financial capital allocation, but as service or equipment. So insurance should be procured like hedging, like financing, like a financial transaction, which is unique, very specialized, and you have to kind of put a lot of effort into each.
It's a financial tool, right? It's not like a commodity that we buy here, huh?
Yeah, exactly. It's so unique to make sure the coverage adequately addresses the actual underlying risk. So procuring through procurement never worked for me, not once. And so that was the first kind of instance when the business tried to push back, and we just went like, guys, leave it to the professionals. And the second time was HR, where HR was saying that we should stay with the current large insurance company, because if we separate property damage and business interruption from health insurance, the health insurance will become more expensive, because they got a good package deal on PDBI plus plus health insurance. So again, like, we've actually went out and separately placed both of these risks, and again proven them completely wrong. So that's another myth that we've put to rest, luckily.
We gotta
But
call
then,
these Mythbusters of insurance, huh?
yeah. Well, that's what we've tried to do, is we've tried to kind of test the market and go with different options, and then just see which one works. And surprise, surprise, most of the scary things that brokers have been telling us turned out to be completely false. And most of the hypotheses that they were considered best practice, again, completely false. And that after like the 5th or 6th best practice that we've busted, you just go like, okay, the whole market is just one big lie. And we started experimenting on everything. Like, we experimenting, and again, I mentioned this before, like, experimenting on everything. We had multiple versions of submissions with different messaging, different highlights, all factually correct, but just like highlighting and spotlighting different messaging, just to see what works better. So that brings me to, I think, the controversial thought of the day. First, I talked about shortlisting 3 or 4 brokers, and then the next thing we would do is we would split all the available markets between these 3 or 4 brokers, and they would have each a clear assignment list. They would not be allowed, and they would be blacklisted if they did, to go and speak to competing underwriters. So they had to, carefully select who they want to talk. Obviously, there's a lot of overlap because, different brokers want to speak to the same, selected few underwriters. So, we had to, sometimes it would randomly allocate it. Sometimes they would like call us back and go like, but please, like, can you give us this person? We have like a really amazing relationship and we know that they are in the market for your type of risk. And then if somebody, if nobody mind that we would reallocate it. This was never really a drama. Like this is one thing that every single person was telling me how much of a drama that would be. And it never was. Like not once. Not once the brokers complained or dropped out. They just went to work and did what they were asked. I mean, I had once a person miscommunicating from Brazil to UK, and the UK person, the reinsurance broker, kind of didn't understand the concept and spoke to somebody they were not supposed to speak. We, quickly discovered it. Everybody apologized, and we just went on. There was like not once I've seen any attempt at foul play, at somebody trying to be unfair, somebody trying to overtake markets, and that thing of separating the markets and having 2 or 3 or 4 brokers working in parallel and trying to get a leading quote, just that provided huge boost in terms of quality of coverage and in terms of price. I mean, that is obviously not enough by itself, but just that activity, it changed the whole market dynamic completely.
And it's just such a beautiful incentive factor, right? Like there's a huge difference if you know, like, hey, you are the only person, the only broker that's going out into the market with that risk, right? Versus they knowing, hey, we compete against these 2 others, we have to win this piece, right? It's just like it makes sense. It's how it's supposed to be, and how like a market should be set up, right? And then step by step, it was just like talked through these myths, etc., into us not doing it like that.
Yeah, I mean, whoever came up with this idea that you need a single broker for the placement, I mean, very clever businessman and highly unethical person. Whoever came up with that.
We're not going to talk about who probably came up with that, but definitely like they were very much incentivized to say that.
Yeah, very, very much so. And so just that one thing made made a huge difference. And it also meant that we were able to test, different approaches to the markets, like different submissions, different roadshows, if we wanted to, different messaging. It's always interesting to see, like, then you can definitely see who works better, like who brings the better questions. By the way, that's another huge sign for me. If before the roadshow the broker is not bringing me any like really good questions from the underwriters, and 90% of the time they don't, because the underwriters are lazy, the brokers are lazy. Whoever is not bringing any good questions, that means they haven't made an effort to either explain the risk or understand the risk. And eventually we stopped relying on just brokers trying to explain our risk. We started doing virtual roadshows and explaining our risks ourselves. The other big thing that I very quickly discovered is that the questionnaires, the standard questionnaires that the brokers use, they were useless at communicating the actual nature of the risk. So we stopped doing questionnaires. We started doing like proper submission documents that we wrote. I mean, that was crazy as well, because every single submission that we would take to the market, that we would give to the brokers to take to the market, we would write like 100% of it. Everything we would write, and again, this is not very common to not just fill in the gaps in somebody else's questionnaire, but like to write the whole narrative, to change completely the structure, to add information that was never asked in the questionnaire, to highlight the important factors. So that changed a lot. And I mean, if I don't forget, maybe the next session in 2 weeks should be about like what a good submission should look like, because like that's a whole separate story. I mean, I've done so much research in trying to understand what triggers, what motivates underwriters, and what actually impacts on the price. And by the way, I've read a draft research paper from one of our analysts this morning, and I've asked him to kind of rewrite the memo because it wasn't, crisp enough. But once he does, I'll show it to you. He did like 200 pages of research on what triggers the underwriter pricing mechanisms, and the drivers that we talked about a while back. So I've got some pretty amazing research on that. So anyway, there's a lot of science in trying to understand how to communicate your risk to the underwriters. But the fact that you have multiple brokers speaking to multiple underwriters and trying to attempt to communicate your risk in different formats and in different strategies, that made a huge difference. As time goes by, I can there's no coming back. Like that's the only way to place risk, is to subdivide the markets and have brokers compete, because only after they bring you the leading quotes and the terms, you can then determine who is a better fit, like who understands your risk better. You can't do that based on a brochure or on some CVs or on a meeting that you have in the office. They have to kind of put the money where the mouth is, and that I discovered makes quite a huge difference. What's been your experience on the other side of the insurance
Yeah,
world?
no, it just like, for me, it's always super exciting to hear a little bit from you, like, especially on a submission piece, like just like a little bit the myths as well. I think what I was still curious about, and where it links a little bit more into my world, is you said like you're against roadshows, right? I just like want to make that clear, right? Like you said like you're against like the on-site roadshows, right? I think like you're a strong advocate for the virtual work roadshows, right?
Yeah.
Then directly
Totally.
talk to the underwriter, right?
Yeah. And I mean, I think it would be fair to kind of rephrase that. I wasn't against the roadshows as a concept. I was against using roadshows as business travel, and wasting everybody's time and money, and kind of using it as an entertainment. I'm all for spending a lot of time with underwriters to make sure the risk is understood and the risk is well explained. And that's impossible without a roadshow. That's impossible without a lot of face-to-face conversations. But you don't have to be physically in the same room. It could be a virtual conversation.
But exactly. No, and that was where it linked a little bit into my view, because I think this is super important to talk to the right people, to talk to the underwriter, like let them ask these questions, right? Because as shared with you before, they have their own models in the background. They need to map that, but they cannot like map or actually contextualize certain risks of you if they don't know about a certain thing, right? I often bring this example of the hurricane hooks for roofs and stuff like that, but it's just like it's anything, right? Like you want like to be able to have this interaction where they actually invest the time to understand the risk, so that they can also in their backend, in their models, etc., apply the right modifiers. This is a little bit also like the point I think that you made before. Like a lot of these people are not incentivized to truly like think about the risk, process it, etc. They just like see on a surface level, look into it, right, and then just like give a price. What we want to have, right, is really to have them look into it, get up with the best price, and also ask the question so they can give you the adequate price. And for that, like there needs to be some form of channel, right, where they can ask you. Roadshows here, for example, like being like a great piece. But then also, I think what resonated a lot is how you position the submissions. Where I'm very excited that we're going to look into these in 2 weeks' time, where you actually add like the right information and be really like more proactive about, I would say, like adding also information that are not in the questionnaire. Because a lot of the stuff that then on the underwriting side people want to see, they are just like not covered in these questionnaires. Yeah. And there we have like these 2 points. On one hand side, enabling them to actually ask these questions and having like this communication stream. And then the second piece is step by step being better in providing this information that they need. And I think like there we actually like also talked a bit about that already, how we are going or already developed a part of that where with ScyAI you can actually, yes, you can create a submission that is fantastic, but also it generates already like the right data in an auditable format for the underwriter that they then can pick and use for their own models. So from my side, more the experience on the underwriting side, I think it's just like really, hey, there's so much things to bridge, so much data lost in translation, so much narrative versus actual facts that we have to discuss, that I think there is like also a little bit like this, there's a lack of trust in what is then sometimes communicated by the broker and so on, because it's always very narrative focused, and this is what we have to overcome. I think that's what you overcome via great submissions, great data provided, and then proactively forcing them to then process your risk and then ask the right question, and then you actually get and converge like to this right understanding of the risk.
Yeah. You try to kind of converge to the right understanding of the risk, because there was some underwriters that we had 7 meetings, and in the 7th meeting they would still ask me something that clearly does not apply and never applied to our mine, and you just go like, how do you even assume that? Like, I thought it was so obvious that this is completely irrelevant to us, like that particular risk should be excluded. But yeah, no, it's surprising. As one of the friendly underwriters told me, they always price super conservatively. So the underwriters may not be motivated to understand the intricacies of your risk, because they'll just double charge you. They don't care. They charge you for everything that is unclear, and they're not really motivated to ask follow-up questions, because they just bake it into the price. And yes, they can price themselves out of the market, but because everybody's doing it, that means like every single quote you receive is overpriced. And so they're not even worried pricing themselves out of the market that much. So unless you can't just sit and wait for the right question to arrive. It never will, because they're not motivated to ask the question. You have to kind of push the narrative, push the data onto them for them to learn. And we have a good question in YouTube. Brokers, data providers, analysts, and underwriters. Who would you want to spend most time with? And to me, it's obviously the underwriters. If it was up to me, I would spend like 70% of the time with the underwriters, trying to explain our risk better, and trying to kind of build this mental puzzle of our exposure. What
Exactly, the right underwriter, right? Like I think I would just add to that, like that has experience in that vertical, in that area. Obviously, I mean, you obviously already think that that's a given. I think I want to add that, just to be super clear, that that they also feel comfortable with the risk, right? And having this conversation with you, because I think some that maybe also are like a little bit intimidated when it goes into too nitty-gritty stuff or things that are too far out of their comfort zone. But yeah, talking to right underwriter from my side too, and enabling that a conversation with the right tech. I think that would be the other thing that I would add.
Yeah, well, yeah, exactly. I mean, it's well that I think that's a message that's worth unpacking in one of the future sessions, because what we're kind of trying to do is we're trying to go through the journey of our successful placements, and I hope the message kind of comes across clearly is that it is a lot of work, and part of the a lot of work is the fact that you have the introductory call with every broker, and you explain this this vision. Like, I would literally spend the first 15 minutes on any call with the broker just explaining the vision, that it's all about risk based, it's about explaining our risk properly, it's about placing the right amount of risk, and finding a fair price and matching the terms to the underlying risk exposure. And everybody goes like, yeah, for sure, like that's exactly what we're all about. Like, every single broker, every single company, what you, this is maybe a little bit too close to home, but I just thought it was absolutely hilarious. I remember speaking to some of the big, like, head of underwriting for mining in Germany and in Switzerland, for the biggest companies in the world, reinsurers. And I remember them saying like, oh, we are like super risk based. It's all about understanding the risks of our clients. And then they go back to me and say, yeah, our maximum capacity is 10%. And I'm going like, what? So you understand the risk, and yet you don't have the balls to take more than 10% of the exposure, even though our actual like total capacity is not that great. And you are this multi-trillion-dollar company, and you're saying you can only take 10%, and you have to share the other 90% with other players because you're scared. Like, that's not risk understanding. That's the opposite of risk
No,
understanding.
the question is like, put your money where your mouth is,
Yeah, well,
and there
exactly.
is no fit then right now in this message. It's just like it's air then, yeah.
So what I think we're trying to show is that coming back to the broker conversation, in the first 15 minutes, yes, um, um, do we're going to do the risk based. We're all risk based. We fully buy into your vision. Literally the next day, they go to the markets and they do exactly what they've done every other time. So they ignore everything we've discussed. So it's like, no, guys, push back. I'm not going to accept. Like, it's such a kind of constant grind, trying to change the world to make this a better placement. And luckily now we can have risk intelligence like ScyAI to do a lot of the legwork, because it's a lot of effort. And right now we are trying to estimate our BI exposure, and it's like it's I think it's like a month of chasing, trying, recalculating, just trying to figure out what's our risk adjusted um, revenue and volumes under various pricing scenarios. There's a lot of quantitative work that has to go into it if you do it manually. So on that note, thank you everybody. Thank you for the questions. Keep don't be shy. Ask questions in LinkedIn as well. I think we've kind of broken the barrier for the questions, and we'll expect more in the coming weeks. And you can also ask questions after you watch the replay. We'll see it and we'll respond, and that will help us shape the conversation for the next sessions. But we have a lot to unpack: submissions, road shows. I mean, oh God, I had a road show 2 days ago. I mean, that was just hilarious. And
Adding Mythbusters and red flag stuff. Like if they talk
exactly.
like the marketing brochure, it's a red flag.
Yeah. Exactly. All right. So thanks everyone, and
Thank you.
we'll
Cheers,
see
guys.
you soon.